So before more people join, let's go ahead and do the introductions. Hello, everyone again. Welcome to AAPI Educational Webinar Series. The topic is current geopolitical volatility and how to allocate your portfolio. AAPI's goal is to educate its members about the importance of financial planning and becoming financially independent. So attendees should consult their own advisors and attorneys for any advice. And AAPI does not endorse any of these suggestions or any company. And this webinar will be recorded, and you can actually get the recording on AAPI website. And I thank Dr. Amit Chakrabarty, who is in the airport currently, the president of AAPI, and he could not join. He'll probably join a little later. But I thank him for this opportunity to host this session. And this event is hosted by me, Satheesh Kathula, immediate past president of AAPI. And then Dr. Vinod Sancheti from New Jersey, who is a very good friend of mine and for years, and he's a board of trustees of AAPI.
Thank you.
And it's a pleasure to have him on board today. And today's guest speaker is Syed Nishat from Wall Street Alliance Group. Syed is a certified financial planner and a certified plan fiduciary advisor. We have done multiple webinars with him in the past, which were really educational and resourceful. And we would like to make it more audience interactive and not a long, boring presentation. I'll ask questions and then Nishat will answer, and then Dr. Sancheti will be asking some questions, and we'll take the questions from the chat box. Again, please ask your questions in the chat box, and we'll try to answer as best as we can. So Nishat, thank you again for coming one more time to educate all of us in AAPI. And thanks everybody for joining today. So before we discuss the market update, a lot of AAPI members were asking that April 15th is a tax deadline. It's around the corner. So do you suggest any last minute tax planning tips for the year 2005, Nishat?
Yeah, thank you everyone for coming. Thank you, Vinod Bhai and Dr. Kathula to come in the Sunday from your busy time. I really appreciate it. So before we talk about like the market, some tips for the year-end tax planning. So the April tax filing deadline coming, which is due like in about less than a month. Unfortunately for 2025, there's not much you can do. Because what happened 2025 already been passed. We should have done most of it by December. And I think we did a webinar with Dr. Chakrabarty and you before the year end. People can go back and see it. So just very few things before April 15 deadline. Contribute into the IRA account if you can, SEP IRA if you can, if you have taken extension. If you have taken extension or if you're a solo practitioner, you can do something called defined benefit plan. Defined benefit plan, as you know, a self-employed physician can contribute at the age of 55, almost close to the vicinity of $250,000 for the year 2025. It is still a tax write-off for you. Very important. Also, last, HSA account. If you have a high deductible insurance before the April 15 deadline, you can contribute about close to $8,500 for the family. So unfortunately, this is the only thing you can do. Now, one thing. You can still have time if a lot of AAPI members, physician invest into something called real estate. If you invest into real estate, if you haven't filed your taxes, you can do something called cost segregation. Still you have time. How does the cost segregation works? If you, let's say, have a real estate for $1 million, the depreciation is 29 years, Dr. Kathula, as you know. But the schedule is up to you. You can bring all the schedule down from 29 years to 1 year if you want to. For $1 million property, if you recently purchase it, if you did some renovation before the tax filing deadline, you can start the cost segregation. For $1 million, you can get about $250,000 negative K1 from the property. You can get to write off from the rental income you collect. So unfortunately, there's nothing much you can do. These are the last minute tax planning tip. Speak to your CFPA if it makes sense for you.
Okay, that's great. So then for the year 2026, how should we prepare ahead of time?
Yeah, so this webinar mainly is for investment management, but API member or you, everyone can take a picture for 2026. And I think we will have another webinar for year 2026 before December. A few of the outline here, pay the estimated taxes, for the year 2026 is very important. If it's possible, Dr. Sancheti and Dr. Kathula, try to bring your income down below 500,000 if you can for the year 2026 by charitable contribution, defined benefit, whatever you can do. Why? Because the Big Beautiful Bill was passed last year. According to the Big Beautiful Bill, if your income is in the range below 500,000, the state and local property tax is only 10,000, right? Uh, when Trump was president, he's president now. But if your income is close to 500,000, below 500,000, the state, local, and property tax is 40,000. This is important for Florida residents a lot. So again, very, very important. Try to bring your income down below 500,000 if you can. The rest of it, take a picture, sit down with your CPA, and discuss which one is applicable for you. Two things I will mention for the year 2026. This is a good year to do something called tax loss harvesting. Like Dr. Sancheti, you invest in the market. You may see Microsoft is down right now, correct? Like
True.
almost 30%. Like Nvidia is down. All the Magnificent Seven are down. If you are losing money, sell it, use this money and buy similar. Like if, let's say, AMD is down, sell it. Giving example, buy Nvidia. I'm just giving example. Now you have the same sector exposure, market goes back up, you make money, but that tax loss you can carry forward, you use it again, your real estate gain and other stock market profit you may have it. It is also a good time for the year 2026 to do Roth conversion, not for the whole portfolio. Like some stocks are down a lot. I'm again giving example like Microsoft, Netflix. If you are down a lot, Bitcoin, I'm giving example, down a lot right now year to date. Do partial Roth conversion. The benefit is when you convert the money, you pay lower taxes because the value is down, it grows back up, it grows tax free, Roth IRA. So these are what the market is down, good time to do it. But the rest of it, you have until December to slowly do it. Hopefully it makes sense.
Is there any limit for Roth conversion, how much you can do, or can you do the whole thing?
They can do the whole thing. But we
Okay,
recommend that do partial Roth conversion, at least some of the stocks which are down.
gotcha.
Yep.
So, okay, from real estate point of view, what are three major mistakes people make in trust planning?
Yeah, from estate planning point of view, I think it's very important before we talk about the market. There are three major mistakes people make in the trust planning. Number one, Dr. Sancheti, Dr. Kathula, people create revocable trust. I think revocable trust is very important because it avoid probate. If a divorce happen between after you pass away with the children, all assets are protected. And you get a step up and cost basis in a revocable trust. Now, there are three major mistakes we see in a trust plan. Number one, people create the revocable trust. They never fund it. Like I had a client in Florida, very nice guy. We speak a lot. We created all the will and trust for the client, my own client, but client is busy. Like I call them every time, doesn't want to move the house, busy, doesn't want to move the brokerage account. It just client is busy. So, but because what happened if you pass away, you haven't moved anything, everything goes through probate. So no point of it's a fancy document. So make sure you move everything under the name of the trust. Okay. Number two is very important. Arrange the documents. Like what happened that we did all the will and trust for a client, the client lost the document. Trust me. After you pass away, where's the document? I cannot find it. So my recommendation is just store somewhere safe, number one. And number two, there's something called die folder. Everyone should have a die folder. Go to Walgreens, get it, and put everything, organize everything. We have a vault called through eMoney. We recommend our client go there and upload everything. So if anything happens to you, children know where to go. Very important. And lastly, in the trust document, we see a mistake. If you pass away, they're giving the money directly under the name of their children. Distribution is a mistake. Our recommendation after put a line there in the trust or will. If anything happens to husband, wife, parents, the child must open their own trust and transfer money out. Again, doesn't go to their hand, they must open their child trust and money goes to them. So these are the three mistakes people make. Be vigilant, talk to your CFP, lawyer, and review it as periodic as you can.
So, for example, if the children are trustees in the trust, will it automatically go to them, or do they have to have a separate trust?
Yeah, you have to specify it in a revocable trust that, the children are the trustee, but they must create something called a lifetime trust for them. And then you transfer. It's not automatic. Otherwise, if you just say, let's say my two children, they are going to be trustee, but if I pass away, maybe at the age of 30, they will get the money under their individual name. But think logically, they get their individual name, they get married, commingle the money, divorce happen. It's very tough situation at that time. So that's why we recommend in the trust and will write a clause. They must open their own trust and transfer money out.
But that can be farmed anytime. It doesn't have to be now. It can be when they are transferring money, they can farm a
Correct.
trust at that time.
At that time, correct. At that time. But the clause is important.
Sure.
Sure.
So, can you please explain, should we do this Trump account versus 529? So what is the difference between those two?
Yeah. So Trump account or MAGA account, I know it's a controversial name. A lot of people don't like it. I think Trump account from July of this year is just starting. If you have a newborn until the year 2028, the government is giving you $1,000. Very powerful for free. That is not the most important thing. The most important thing is that you, me, employer, your friends, anyone can contribute for that newborn as long as the child is below 18, $5,000 combined altogether. An employer can contribute about $2,500 for the employee. And that's very, very good. And it almost work as like a retirement account. It doesn't have to be only for education purpose. All right. So now a lot of people ask question, should we have a 529 or should we have a Trump account? We recommend both because remember this 5,000 is on top of the 19,000 you can contribute per child into the 529. And imagine this way, like a MAGA account or Trump account is like a retirement account for the child. And you get $1,000 if you have a newborn, like a grandchildren or your own children until the year 2028. So we like it. I think this is a complementary on top of the 529. My suggestion is to sit down with your financial advisor, do both.
That makes sense to do both to get the maximum benefit out of that. So I did 529 at that time, and there was no Trump account. So, but I think those who are doing it newly, I think it makes sense to do both.
Correct.
So now going back to market, some questions for the audience to understand. So can you please explain what is the difference between core CPI and core PCI, and what is connected with inflation?
Yeah, I mean, so far, if you see most of my webinar about, estate planning, tax planning, now I'm going to wear a hat of, economics. Hopefully, it kind of makes sense. Before we talk about like a big jargon, and Dr. Sancheti knows more than I know, and that's why there's a reason why you brought him here, I think, that I will talk a little bit for the audience to understand few core concepts. One, we have to understand something called CPI. It's a consumer price index. I mean, you probably open CNBC, you see it all the time. What is CPI, Consumer Core Index? It's like Vinod, Dr. Sancheti or to Kathula, you buy your iPhone. How much do you spend? How much as an individual, you and I, spending money. What happened that Department of Bureau, Labor, every month they do like an average of 80,000 household item, and they just find out, okay, inflation, how much is it? So that's called CPI. Simple. CPI usually hover around close to 2 to 2.5% ballpark. That's what the target is for the Fed. There's something called PPI, which is called Producer Price Index. The audience needs to understand it before we go into the market because these are all tied up. And you can see all these CNBC gurus talk about it. What is that? PPI is a producer price index. So before Dr. Sancheti, you buy your iPhone, how much Apple spend money and what's the inflation rate for that? That's called PPI before it goes to consumer. That's also important. All right. What does Fed use to measure the inflation? That's important. There's none of them. they use something called PCE, which is called personal consumption expenditure. That's what Fed uses. Not the CPI, not the PPI, it's the middle. PCE basically is called personal consumption expenditure. It measures more than just the CPI, and it gives a good understanding how much the inflation is going to be. Why is it important? You might be asking, Dr. Kathula. What happened, the target for that, Fed has it around 2%. What's the target? 2%. But it is right now 3.1%. Again, at the beginning of the year, it started at 3.1%. So for audience to just, it needs to must understand it, what's happening this year. These three terminology are very important to understand that PCE is 3.1, the target is 2. Then I'll explain further as the questions are coming. Hope it makes sense.
Great. Yeah, it does, Syed. So what is the price earnings ratio and why is this important?
Second part of the equation, you must need to understand the PE ratio, price to earning ratio. What does it mean? It means in order to make $1, how much you have to spend. For example, I'm giving example, Microsoft PE is 15. What does it mean? You have to spend $15 to make $1. So Dr. Sancheti, your economics, is the PE high better or low better? You
Low
think?
better.
Yeah, because you have to spend low, right?
Correct.
Exactly. So PE gotta be lower to make money. So if you see in economics, PE is high, P is high, something is wrong, that means market is high. Hopefully it makes sense, simple terminology.
So what does consumer spending mean and why is this important?
All right. So now the third part, we need to understand something called consumer spending. So what happened that in GDP, gross domestic product, what happened, the big component is consumer, how much you're spending. Dr. Sancheti spend a lot if the market goes up. So far, I remember he buys his good car and everything. When the market goes down, he's not happy. So that's called consumer spending behavior. 60% of GDP is consumer spending in America. What percentage? 60. Now, what happened that top 10% in America, top 10% who makes more than 250, 60% of the consumer spending comes from them. That's very important, okay? Sentiment. That sentiment can change if the market drops. If the market drops, Dr. Sancheti feels poor, although he's not. So he doesn't spend much. So consumer spending goes up, confidence is up. That's very important. So these are a few concepts you need to understand before you talk about the market. Hopefully the audience are kind of getting it. It's not too boring.
Yeah, that makes sense, Syed. So we see major corrections in tech sector, and I wonder why we see that much correction there, and also just the AI disruption. Do you think that's an issue?
Yeah.
Because there's
So
so much of AI, in
right.
technology nowadays. Yeah.
Correct. So what's happening that the price to earning ratio. Now let's go back. We spoke about consumer spending. We talked about PE. We talked about PCE. So how does it kind of affect the whole equation? So at the beginning of the year, Dr. Sancheti and Dr. Kathula, if you remember, we sent out email to all API members and all the physicians. And my business partner, Adil, he comes to CNBC quite often. We spoke about the valuation for technology sector is very high. The P is very, very high. Dr. Sancheti, maybe, do you know by any chance the S&P forward-looking PE at the beginning of the year?
This year, historically, S&P should be around 18 to 22.
Right.
Right now, I think all S&P stocks, the P ratio is much higher.
Much higher, absolutely. So the forward-looking PE, I'm just saying America, it started with almost 21. I'm just giving forward-looking PE. That includes the AI and all of it. Now, what's happening, Dr. Kathula, that inflation, remember, is 1 bips, like 100 basis point higher than what the target should be. Like the Fed target is 2, came 3, right? So the borrowing, what happened, the interest rate is not going down. It is going up, unfortunately. The company get affected the most are software. because they borrow the most amount of money. So that's why all the software sector, there's a revaluation is setting in, number one. Number two is AI. You see AI, they need data center. You must have heard about that, Kathula. All data center, Dubai, India, they're making it. That is becoming about close to almost 20% of their capital budget. That is becoming almost 20%. So their net profit margin getting squeezed quite a bit. And that's why you see all the layoff is happening. The layoff is not happening because, AI is doing great job. What's happening is that because they need money. So that's what the layoff is happening. So because of the huge spender coming, that's why you see massive technology sell-off is happening, especially that particular sector, because they went up the most also for the last 2 years. Crazy. So that's why the correction is happening into the technology sector. AI, is it making a mass layoff? We are yet to see it. I think mass layoff coming is because of the data center they're making. But what happening is a K-shaped recovery. Dr. Sancheti, heard about K-shape? It's not like a full, so some people are making money. Like, for example, plumbers, electricians, Dr. Sancheti, physicians, you guys are making money. A huge demand. But certified charter financial and CFA, they're losing money because what happened, like this, Dr. Kathula, this PowerPoint, Dr. Sancheti, you see it? It used to take me 2 weeks to make it, but market fell. I made it. You know how long? This one, this is done by Gamma, just to let you know. GAMA. It's an AI. 2 minute. 2 minute.
Yeah.
I didn't even put the data. They did it. I just have to double check it, and that's it. So all the analyst jobs are going away. And then basically what's happening, something like talking, like AI cannot talk like me yet, hopefully, but I talk okay. So people like me talking well, Dr. Kathula, you sing well, Dr. Sancheti, you speak well, we are doing okay. So as long as communication is there, we are doing okay. So K-shaped recovery is happening. Some people are losing jobs, some people are making good amount of money. So that's why you're saying that the tech sector, that's why is pretty much falling. AI disruption, massive layoff hasn't happened yet. I know it's a long answer, but hopefully it makes sense.
AI is replacing everything, even in the creative field. You can sing a Syed with AI. You can compose a song. You can do a lot of things with AI, actually.
Correct.
But I think it's coming. I mean, it's a revolution, basically. So we have to embrace it. Definitely there are issues with that, but I think mostly good. So let's hope. So okay, how do the points that you mentioned, like core CPI and the PE and the software sector correction affect the market outlook for this year, 2026?
Good. Now let's plug in everything together. Let me repeat one more time. We talked about PPI, we talked about PCE, remember? We talked about number two, the tech market sell-off. We spoke about it. Number three, we spoke about the inflation rate high, and we talked about higher valuation PE in the tech sector. Let's plug in all together. Where does it go? So if you read it in my screen, hopefully you guys can see it. The core PCE is 3, well above what Fed is targeting. And the PPI, which is a producer price index, that is also going up as well. It's not going down. So eventually it will help the CPI. Fed, do you remember, Dr. Sancheti, how many times Fed cut the rate last year?
5 times.
Okay. Okay, very close. So this year, I mean, let me ask you this. So inflation is going up. In order to fix the inflation, what Fed needs to do, you think?
Increase the interest rate.
But we have a government who who wants to decrease the rate. All right. Now we have seen recently mass layoff is coming, right? Unemployment is high. Can Fed cut the rate? Unemployment is high. This is a question, Dr. Sancheti, for you. You think Fed can cut the rate if the unemployment is high and inflation is high?
Fed will be forced to cut the rate, by new incoming Fed is coming. So
right, but it's
not in July meeting, not in June.
But this is a limbo, Dr. Kathula. Hopefully it makes sense that Fed is in a limbo. How can I cut rate? If I cut rate, inflation will shoot up.
Correct.
But I cannot cut rate because and unemployment is very high. So that's why people are talking about Iraq, and all of Iran, all of it. But the January we started with this. That's the main issue, though. This year is all about inflation, all about PCE. Now, what happened that that's why interest rate you see is going higher. Bonds are falling, yields are going high. So that's why the interest rate is a big issue, not the Iran war. We'll talk about it a little bit, but the sectors are underperforming at technology. Financial, by the way, just to let you know, financial down 20-30% year to date because of the high inflation. People will be unable to refinance it. Is very important. And long duration bonds, they are falling. What is going high this year are energy, industrial, and utility. They are basically going high. So again, these are very important. We have to monitor the Fed. I do not know. That's what the market is very, worried about, that what the Fed is going to do, because the chances, if you see it in the next screen, that there's only like less than, I think, 30% chance Fed will cut the rate in July. Less than 30. I think they will just cut only one time. But the stock market wants the rate to be lower. And I don't know how the Fed will cut it. Maybe the new Fed doesn't even care. Who cares about the economy? Just cut it. And if you just say, and the market may shoot up, may. But if you take a look at Japan, ECB, which is European, they have increased the rate. But unfortunately, in our situation, this is the big limbo, the big dilemma. I hope the audience are understanding that the main issue is the inflation. The rest are kind of side effect.
So with this war, I mean, everybody's worried, obviously. So there are different opinions in the market. Can you explain about the war effect on the economy and the market?
Yeah. So the Iran conflict, is a wild card. We are talking about, obviously, everyone have different theory, and I'm going to talk about the two theory, but there's no way I am supporting any of the president or anything, but I'm just giving suggestion what the market is saying. So what happened that because of Iran, Dr. Sancheti, if a war happened, what goes up, you think?
Oil prices goes up and gold and silver should go up too, but
Yeah. So if oil goes up, what happened? Inflation goes up or down?
inflation goes up.
Right. And we spoke about inflation is already up, right? So it's just adding fuel to the fire. And that's what basically happening right now into the Iran war is happening. Now, talk about Iran, people are asking what is going to happen. So everyone somehow becoming expert. Like I had a client who's cardiologist, just send me a long chat GPT. I think he got it. Just send me an email that it will become like a major havoc. Oil will go to 200. We will not have food on the grocery store. Inflation will be out of control. So, I mean, it happens. Everyone becoming now suddenly expert. Like, Iran has been preparing for war for the last 200. They're ready. I mean, again, emotions runs very high. So, but in my opinion, there are two suggestions going on. If you look at the positive side of it, let me just share another, screen with you. You can probably see it. And this research report, basically, I have shared it. I've emailed to everyone. So if you take a look, I hopefully, the screen is sharing. And it's a little, but I'm just going to put the slide up there. So previous wars, if you take a look, we had 1990s, 1991 Gulf War. Then we have Iraq War. And then obviously we have the Ukraine war recently. So during the Gulf War time, the short term I'm talking about, I'm hovering my mouse, market did fell around 15%. It did fell. During the war, if you seek a 9/11, the war happened, the market did fell 10%. Then Iraq war market did fell more than 15%. But take a look at subsequent 1 year return. 15 months return, the market always went up almost double digit. Every time there's a war happen, usually there's a shock people are talking about. But a lot of questions people are asking, Dr. Sancheti, Dr. Kathula, is the crude oil will become similar to 1970? I started my career 2003. Dr. Sancheti, do you remember what happened 1970? By any chance?
No.
Those were like, the oil embargo. I don't know if you remember all the OPEC major oil price, they've increased it, and it shocked the market. We don't believe, as an analyst, our CFA doesn't believe that it will become like 1970. We don't think so. Because what happened, if you take a look at the bottom, then US were heavily, heavily dependent on OPEC, which is Saudi. They were heavily dependent at that time. But now, our president took over Venezuela, by the way, before this happened. Our president is about to take over Cuba, looks like. That may happen. And we are one of the largest oil and natural gas provider in the whole world. We are this 2026. So the way to see it, I'm again talking about positive. Before this Iran war, Trump positioned itself like Venezuela, all producing. We are immune to it. It's a good time to get this issue resolved with Iran. When the oil price goes up, you know which countries affected the most? Think logically. Which countries affect the most, you think?
India and China.
India and China. And these are the two countries did not negotiated well with trade with the United States. They did not. Modi did not. This Chinese president, he did not. Now, if you see China this morning sent out a news, we are ready to speak. Let's speak because this war is coming. They import China the most. Trump is saying, wait, I'm not in a rush. I'll see what happens. So in our opinion, it's more of a strategic move. And it's another move to do a trade war done, in my opinion. The trade tariff is still going on. And Dr. Sancheti, you heard about call and put? You heard about covered call, covered put?
Yes, yes.
So put is Dr. Kathula, you buy it when the market is down. You sell a call when the market is up. In Wall Street, we jokingly say sometimes market will not go down because we have a Trump put. We have a Donald Trump who will not let the market fall too much. That's his legacy. So in our opinion, I understand that inflation is an issue. Is as soon as Donald Trump see that market is going down too much, he will make some announcement that the war is over and the market will shoot back up. This is called positive swing. Negative swing, people are talking about, no, it will become like the war like Ukraine, it will drag forever. Everyone will become like a major havoc. We don't think that is going to happen, but anything can happen in life. But Wall Street, that's why it is going down, but not too much. And oil price is going up, but not too much. If you see the oil stocks, so we believe that this is a short term, and the catalyst will be over very soon. So I know it's a long answer, but I gave you both sides of the stories.
Okay, that is good, Syed. Let's hope the war will end soon.
Yeah.
We don't want war between any countries, but again, that has a different effect on economy, mostly positive. But I am a peace lover, so I can say that.
Yeah.
But I'll turn this over to Dr. Vinod Sancheti, who is the BOT of AAPI, and he's a seasoned investor, entrepreneur, and as you have seen, he knows all the answers. So I'll turn this over to Dr. Vinod Sancheti. Dr. Sancheti, please.
Thank you, Satheesh. On behalf of the AAPI members, you were asking Syed excellent questions. So now from here on, I'll ask Syed question number one will be, how in this market Trump tariff come into play? Please let our audience know.
Yeah, so I think market is kind of immune to this tariff. Remember the Liberation Day, which was April of last year, market did fall. We had a webinar at that time. But I think most of the negotiation is going on. I think the steel and aluminum, those negotiations still going on. But what happened that because of this tariff, in the CPI, about 0.5% to 1% been added. The inflation went up a little bit because what happened, the companies, they are the one paying high tariff, and it's gonna go to the consumer, right? Pretty much. So it did, but looks like the Wall Street has already been immune to it. We believe that the tariffs will be negotiated further now with the countries that didn't negotiate it before, which is like India and China, because of this war issue. And we believe some sort of negotiation will happen. Yeah.
Thank you, Syed. Syed, just tell our audience about everybody's hearing that private credit risk is the bubble is going to burst. About private credit risk.
Yeah, so private credit risk. So Dr. Let me just tell you a little background. So I bought my condo. You don't see at the back. because I'm covering it with our logo. So I bought my condo, Manhattan, New York City, in the year before COVID, 2000. So I went for something called 7 years ARM. You know what 7 years ARM is? Like after 7 years, the interest rate reset. And my interest rate was 2% at that time, 2.25. And what happened? I was lazy. You can call me stupid because I did not refinance it. In the middle, Dr. Kathula, I don't know if you remember, you had the option to refinance for 30 years.
Yes.
I hope you went for 30 years, but I went for 7 years. And my ARM is expiring this year, 2027. And my interest rate from 2% will jump to 7, unfortunately. So what happening that this is the year most of the 7 years ARMs are expiring. In 3 more years, 10 years will expire. So so I would say a decent amount, almost 30% in American went for the 7 years ARM, like me. So what happened? Companies also went for 7 years ARM. A lot of companies went, pre-COVID and after COVID, 2000, 2003, and now they're becoming something called floating rate. Floating rate is becoming floating rate. So what they're doing, they borrowed the money before, right? They purchased real estate, and then what's happening now? They have to refinance it, refi it. So, and what they did, they bought real estate. And this whole idea called private investment or alternative investment. I'm sure you heard about that, Sancheti, right? Alternative investment, like Blue Owl, Blackstone, you heard about it. So what's happening that then the copycats came in. Unfortunately, a lot of physicians, they invest into multi-units. They raise money from you and me. I'm sure that API have different product people come in, and do you see it, Dr. Kathula, that 7 years 7% guarantee, 8%
Yes,
guarantee?
I've seen that. Yeah.
Yeah, that is also a private investment alternative. So they're copycat of the big people. That's what they did. But what's happening that they are raising money from you and me. Dr. Sancheti, Dr. Sancheti, you have a lot of money, Dr. Kathula, but I'm a poor guy. Let's say if I invest, uh, I don't want to lock up for 10 years. I need the money. And whenever I'm hearing the news that this private credit is bursting, I want to get out of the money. But there's a problem. These are illiquid. You cannot just take this money anytime sooner. All right. You heard about most likely, I think, Evergreen Fund, like, these are, and it's a huge amount of redemption is coming. So, but we have to talk about the headline versus what the reality. These are the headline. $1 trillion bubble is bursting. So what's happening that the top company like Blackstone, Blue Owl, they're okay. The problem is the copycat. The smaller company like physicians, 4 or 5 people raise 100 million. They are the one most likely file for insolvency. That's why in my last webinar, I always say buy index fund. Don't go to this alternative investment high return. It's too good to be true. All right. So this is problem. Number two, defaults are rising. Yes, but only 2%. The reality is only 2%. It's just like the smaller company, they will not be able to refinance 7%. They are the one losing money. And then lastly, you will see, you must have heard about in Barron's or Wall Street Journal, investors are trapped. Hey, investors are supposed to be trapped in alternatives. It is illiquid anyway. You're supposed to hold it for 10 years. But now you're panicking, you're selling it, but it's not a good time to sell it, this private placement, unless like it's a bad one, because you will get 80 cents per $1. So my suggestion will be the middle market is still, the earnings are high. It is not a systematic risk. It is just like be careful. That's why we always recommend be careful. Don't invest into all this API or other seminars, webinars. You see the private credit, 8% guaranteed return. Be very careful. That's all I'm saying. But it is an issue.
Thank you, Syed. The next question is, what's the effect of US dollar?
Yeah. So dollar is
in comparison to other countries, BRIC countries or emerging market countries, their currency.
Yeah, so dollar is a big issue. So I think that the bigger issue is something else, though, Dr. Sancheti and Dr. Kathula, that I think the videos are getting recorded and people can probably, I highly recommend reading Ray Dalio's Principal book. I highly recommend. He spoke about it, that, the dollar, because what happened that so many people are, countries are dependent on America. They don't want to be dependent anymore. People are getting, other countries are getting tired. So you must have heard about BRICS, that there's similar currency coming in. And nowadays you'll be surprised because I'm going to Japan and next week, a lot of people go to Vietnam, and everywhere. Looks like about 30% of global trade actually happening not in dollar anymore. You can just pay for their local currency and do the business. So I think less and less as time progressing, China, other emerging market will become a superpower. They want to be less dependent in America. This is the trend. But the just to let you know, the U.S. government wants the dollar to be not too strong because the foreigners will not invest here. Okay, you understand? Dollar is cheaper; they invest in it. So we want the dollar to be kind of minimum to a little bit going down every year. So that is very important. We will not be able to give you a target what is going to happen, but what happen if dollar becomes stronger? Dr. Sancheti, if dollar becomes stronger, what happen? Does gold goes up or gold goes down? You think?
Gold goes down.
Yeah, because people want dollar, right? So that's why you see gold is going down. Gold is going down, Bitcoin going down because of that. So short-term dollar because of inflation has gone up, but that's another dilemma we are seeing in the market as well.
So, but rupee is actually going down though.
Correct. Rupee is going down because some other issue going on. Rupees because of the foreign, they're losing money. The people are investing in other currencies, not rupees. That's one of the reasons. Yeah.
So, Sayed, if I ask you main question, what common investor should do now? Should they stay invested, buy some more, sell everything? What should be done?
Yeah. So, Sancheti to Kathula, Sancheti, you know how much is the stock market down year to date? Any idea?
It's only 6%.
It's only
Yeah.
6%.
Yeah.
It's nothing at all. And just to give you, I'm doing it for almost more than 20 years. 5% correction, like 5-6% correction happen every year, 2-3 times. Not a big deal at all. Nothing to worry about. It's a 10% drop usually happen every 2 years. 10% drop. That's what we are interested in. And 20% drop happen, I would say, every 4 to 7 years. So 2022 market drop, 23, 24, 25, maybe 26, 27 market may drop. I don't know, but it's been 4 years, 4 to 5 years, the rotation is. So if you're asking me that what should we do, market is only down year to date 5-6. Nasdaq is down from the top 10%, just to let you know. Now, what the problem is happening that AAPI members, because I do a lot of AAPI and physicians mainly, they are not buying index funds. You know what they do? They just buy this company like Nvidia, Apple, Microsoft. So I met a client in New Jersey, husband, wife. We're sitting there chatting. They love stock market, sell covered call. I say, okay, before I left, I said, let me look at your portfolio. Guess what? 20% into Nvidia. That's what they do. 20, and they like gambling. They sell covered call and 20. So this is something you should avoid it. So what's happening that a lot of physicians they're not buying index fund. They're buying this 5-6 stock. And just to let you know, Amazon, Apple, Microsoft is down 30%, year to date. So that their portfolio is down more than the market. Looks like it, although the market is not done that much. So in my opinion, this is not the time to jump in. You should just hold on to it because it's not like it's not a bear market yet. It's just down 5%. What's the big deal? If you want to buy it, if you don't have this Microsoft, these companies, you can go to our website and see our CNBC video, what stocks we're buying. You can buy some of this partially, but you cannot buy too much in this market. We should wait for a more pullback. My suggestion is, if you're asking Dr. Sancheti where investors should invest, I again highly recommend don't buy individual stock. You don't have time for it, like Dr. Sancheti. Not everyone has time for it. Not everyone is gifted, maybe like Dr. Sancheti. I think that most investors are busy and they should buy index funds. And let me give you a statistic, Dr. Sancheti, for you that for the last 3 years, US equity fund, how much they have underperformed last 3 years, 88%. Last 5 years, 93%. Last 20 years, 98%. Only 2% people outperform. And those people who outperform, they don't come to webinar on Sunday. You call them, they don't come. All right, they're very good. So that's why no one can beat the market. My recommendation is to buy index funds like SPY, but my also recommendation would be to buy international, because what happened that buying everything SPY, I think it is a mistake. You have to diversify a little bit, buy some international, because international PE, remember price earning ratio, is only 12, 13. They're cheaper. And in America, 35% is technology, is very concentrated SPY, but international is only 8 to 9%. So the investors are looking into it. That's why if you see international ETF index funds are going higher. So in my opinion, investors should say stay put, don't have to panic and buy or sell. Like my clients are sending me email, Iraq war will go forever, Iran won't sell everything. Don't do that. Just stay put. Market goes down more than 10% correction, start buying it, do something called dollar cost average. That's very important. And lastly, Dr. Sancheti, I would say it, there are four types of portfolio: conservative, moderate, growth, aggressive growth. Again, conservative, moderate, growth, aggressive growth. I am 46. I will, my retirement account, I am growth. So if you're my age, retirement account, don't time it. 100% buy SPY, QQQ, index funds. Okay, simple. If you are at the age of 66, I'm just giving an example, and your net worth is below 6 million. What happened at the Sancheti in America? You need 6 million to be happy. Why? 6 million, 4% you withdraw every year, which is 240,000 Social Security. That's 300,000 for you. Do you divide by 12? You have to pay taxes. You don't need long-term care, nothing. If your net worth is below 6 million, you're 66, you don't have long-term care, you gotta be conservative, sir. Doesn't matter what the market does. You gotta be conservative from the day one. You cannot take too much risk. If your net worth is more than 10 million, then you could be between moderate and growth. 80, 20, 70, 30, because market goes 10 million will become 6 million. No big deal. Okay. If your net worth is north of 20 million, like I'm giving you a hypothetical, Dr. Kathula, maybe like you, just go all aggressive, because 20 million will become 10 million. Nothing to worry about. So this is the way. And then if you cannot see your portfolio go down short term, don't invest, for God's sake. Do not invest if your long term horizon is not more than 10 years. Do not invest, for God's sake. You will lose money in the stock market. So I know it's a long answer again, Dr. Sancheti, what to explain, but just to summarize it, market is not down that much at all. Stay put. If it goes down more than 10%, which may happen, you can think about doing a dollar cost average.
Thank you, Syed. The question is from our audience on behalf of all MAPI members. As you said, the index is only corrected between 5 and 7%, but individual stocks, some of them like Microsoft or Amazon or Salesforce, they corrected close to, I think, 35 to 40%. So in the situation like this, our member would like to know which sector to avoid.
Yeah. This year. Yeah, the sectors to avoid, number one, biotech. That's JFK, our healthcare. So he's talking about capping the price of the drug companies as well. So biotech sector speculation is one. XBI, if you Google it, there's an index fund. They are down 15% last 5 years. So try to avoid those sectors if you can. Manhattan, the real estate vacancy is still huge. I see it, and most likely restaurant may pick up, but try to avoid those sectors if you can. Commercial real estate, Dr. Sancheti, I had a client I was talking to. They're buying like a property in Dallas or Texas, and so they had a Starbucks there and 3 more properties like a nail salon or something. And that guy they're buying from, he bought it like in 2023 before the inflation, and he just selling it with 100% cap, and they're jumping up and down and buying it. Hey, by the way, if Starbucks sell their property for some reason, if one tenant is gone, you'll be screwed. And then inflation is keep going higher. So my recommendation will be strip mall, be careful. All right. Try to look for multi-unit residential property if you can. Commercial, be very careful. So again, biotech, ignore it. Office space, ignore it. And strip mall, be very, very careful in this market. Try to avoid if you can.
And even travel company stocks too, right? I mean, especially when there is war and things like that. Probably that too, that one to avoid as well, right? Right?
Yeah. So what happened that they're already down. So if because what happened now, like I'm from Dhaka, flight from Dhaka is taking the West Coast route, right? So their cost is going higher. So it is time maybe if the war, which we believe will be over, like Delta Airline, those are down a lot. Financial, they are down a lot. It may be a good time to add a little position into it, a little bit add it, because we
Okay.
believe that when things are down to buy it. But don't put too much into it. You have to diversify. But what happened, Sancheti, if I say that, I don't want the audience to go and start buying these companies, because what happened, they will buy a lot. It will become disproportion. They will lose money. So the best thing I recommend, don't do any of this. Just buy index funds because it's diversified already for you.
True. Thank you, Sayed. So what's your S&P target for this calendar year, 2026?
Yeah. So what happened that what we don't want to do in this webinar to give target, then what happened then, people will hold up to it. So what we do believe that Fed, there's a 6 to 8% moderate earning and one rate cut. We believe this is the base case scenario. In my opinion, S&P should be 6 to 8% from here as of close of last Friday. But bull case is, core CPI may go down. We don't know that. It may go down. Fed may be able to control it. I don't know. If core CPI goes down with the Fed target, it's a bull case scenario 7,600, which is 1,000 point from here. Bull case. Bear case scenario, like people are pro-war, they think war will be there for a long time. It's a 15% correction. It may happen because like 2022, it may happen. So we just have to be prepared for it. We are in the middle. I don't think next week market will short up or anything. We have to yet to see. Investor in this webinar, the recording will be given to you. We just have to be prepared for it, what to do in these scenarios.
So next question is how often you should rebalance your portfolio?
Yeah, there are two types of rebalance. One rebalance is like we do quarterly meeting with our clients, right? And then we rebalance. So my recommendation every 3 to 4 months, at least rebalance which stock. Let's say you had Apple stock. We believe if you buy individual stock, our core philosophy, Wall Street Alliance Group, we have 1.2 billion with Fidelity, our custodian with Uzek. We have CFA, CFP in our team. So we do quarterly rebalance at least. So if one stock goes up more than the threshold should be, we sell it. Individual stock, we don't have more than 2% into our portfolio. ETF, about 10% of the portfolio, each ETF. And we trim it if it goes up quarterly. There's something called automatic threshold. Let's say, like this year, Dr. Sancheti, Dr. Kathula, our clients, we're already calling aggressively. Market is down. It's a good time to dollar cost average. So only financial advisor can do it. You may not have time to do it. So there are two types of rebalance. One, every quarterly discipline. Otherwise, other option could be you can have time, watch the market. If a threshold goes up and down, change it. My suggestion to do both if you have time to do it. But the beauty of buying index fund, you don't have to rebalance too much. You can just buy and hold, and you're good to go as long as you have multiple index funds. So my recommendation again, official hybrid is the way to go. But what you don't want to do, time the market, Dr. Sancheti. Like remember the cardiology client I spoke about? He wanted me to sell 50-60%. Same guy sold during Liberation Day, which is last year April. Sell it. So try not to be like this. Just be disciplined. Don't try to time it because market timing is very dangerous. No one knows how to time the market.
So it looks like a financial planner still makes money when market is down, but the average investor lose money. My question to you is paying a CFP or certified financial planner 1% asset under management fees worth it?
Yeah, so if you're using financial advisor for just the investment purpose, you will be disappointed. I can tell you, you'll be disappointed. It's because I am doing it for more than 20 years. If you ask me, Sayed, did you beat the market? Did your team 1.2 billion beat the market? No, I don't know how to beat the market. If I beat the market, I don't need to come to the webinar. I can just do it myself. I come to webinar to provide other services beside the investment management. And the fees you pay, 1%, that includes other services. And which are the services? For example, estate planning. Um, if the market is down, you call us, we talk to you, we walk you through it. Physician sell their practice, we sit down and discuss with them. Then retirement, like one of my client taking RMD, required minimum distribution. One is a good time to do so. Social Security, one is a good time to do so. We sit down with your CPA. So all of this coordination under one house, we do it, and there's no separate cost for it. All right. So if you need those services plus investment management, the 1% or depending, the fees usually goes down as your asset is more, then it makes sense. But if you're just doing for investment purpose, and you are using financial advisors to beat the market, in my opinion, you will be disappointed. They cannot beat the market.
Okay, thank you. I have some other questions. Some of my friends, while our webinar is going on, they're saying, what will happen to silver and gold in next 3 to 6 months?
Yeah. So silver and gold, what happened that gold tends to go higher during wartime and when the interest rate goes high. But right now, gold and silver is falling because of dollar become stronger for the time being. But it's a good time to have some. The reason why silver fall, because they tend to be more volatile than gold. That's why they are falling, but they went up also more last year. So gold, I think you should have around 4 to 5% of your portfolio,
And what
in my
about
opinion.
silver?
Silver, we as a advisor not buying it for our clients. We are not because of the too much volatile for us. But maybe if you're buying 5%, maybe 2.5% into gold, 2.5% silver may be okay. You can think about like index fund like SLV, but our compliance doesn't allow a specific recommendation, but you can take a look into something similar.
So, just from the token where you said SLV, that's a silver ETF. It has already fallen close to 35% from peak, like 3 or 4 weeks ago.
Correct.
So,
Correct.
what should investor do?
If you don't have it, I think gold, silver should be about 5% altogether in your portfolio, in our opinion. Yes.
And what about Bitcoin? A lot of people, why Bitcoin is falling despite Trump put?
Yeah. So what happened that Bitcoin is tends to be, why Bitcoin goes up because there's a demand versus supply. It's not backed by anything, right? You know that. So what happened, market tends to be volatile. Individual investors tend to sell the speculative, positions. And a lot of Bitcoin people use margin to buy it. And then what happened that people do get margin call because what happened that speculative stocks like Bitcoin tends to go down a lot if the market volatility happens because they're not backed by anything. It's all about volume versus supply versus demand, right? So that's why you can see it's a huge. And then what happened that there's something called margin call if like more than 60% ratio if it doesn't get covered. So then heavy selling pressure in Bitcoin tends to go down, and that's what's happening right now. So up to 1% of the portfolio, we do believe you should have Bitcoin, in my opinion. 1%.
Okay. Just last two questions. What about selling a covered call? I know this option, totally altogether different topic, but some of our physicians are expert in, so-called they're expert in options, whether it's call option or selling a put. So what about selling a covered call for defensive stock in this market, like Lockheed Martin, which are going up, oil stock, Chevron, Exxon, they're all going up. So you're selling like 3 months ahead covered call for price which is higher than current price of that particular stock and get some money.
Yeah, we believe selling covered call is a good idea because you get basically a premium, a decent amount of premium nowadays. So, for example, the energy stock is up up to 3 to 4% energy is fine. But you don't want to you don't want to you don't want to sell the energy anyway, but it's record high. Remember, you sell a covered call when the price is high, not when the price is down. Microsoft selling covered call is a bad idea because the stock is down, but defensive stock right now is record high. Maybe you can sell a covered call 3 months out, 6 months out in a retirement account. What happened that if you do in a non-retirement, you have to pay capital gain. But in a retirement account, I think you can sell a covered call out of the money 3 months out and get premium. I think it does make sense to do so.
And I think, what about emerging market? What each portfolio should have? What percent is stock allocation for emerging market stocks?
Yeah, so allocation, in our opinion, so we are allocating at least 10 to 14 to 15% of the allocation is international market. It's not just emerging market, international. Like, for example, we are putting some money into Mexico, Japan, China, Europe. As I mentioned, our compliance doesn't allow to give specific recommendation, but you can go to Vanguard website and see index fund for Europe, index fund for Japan, or you can buy a total international market ex-US. You have to type ex-US, not US. So you can put some money into that, up to 10 to 15%. We do recommend because international PE ratio is very low compared to America, and there's a good valuation there, and long term it will go high, we believe.
Good. Now,
So there are some questions in the chat box too. Are you getting the personal texts, Vinod? You're answering. There are some in chat box too. Maybe we can take a couple of those.
Yes. Satheesh,
So
you can
Dr.
take it.
Bandaru.
Yes, please.
Yeah, let's go one after the other, I guess. So Lakshman Rao Bandaru, Dr. Bandaru is asking a question for retired people who are drawing RMD, which is the required minimum distribution. What recommendation you have?
Yeah, so RMD you have to take after the age of 73. You do. So because the market is down, so when you're selling it, hopefully you have some bonds in the portfolio. Hopefully, if you have all equity, what happened? That's called sequential risk. Hopefully you have a good financial advisor who are selling some bonds right now. Don't buy individual stocks though, because they are down. It will most likely will go higher from here in the next 3 years. You should have a good bucket. So if you're taking RMD, you should have a bond. The bond portion, sell it, and take something called monthly withdrawal. Don't have to like sell everything and take one some short, but you have to sell a lot. My recommendation, just take monthly withdrawal, sell the bond portion, long-term bond portion, because they are volatile anyway. So that will be my recommendation.
I have another question from New Jersey. Dr. Asha Nath, it said the New Jersey couple with 20% stake in NVIDIA sale to get into index fund would incur capital gains. Is it still beneficial?
Yeah, I mean, there's more to it. It's a very loaded question because I have to sit down and discuss, how much taxes you're going to pay because it's a liability, right? If you just say something right now over the webinar like this, but there's a lot of options. Sit down with your financial advisor. There's something called exchange fund. One option could be you can put the money into it. It's tax deferred. There's a lockup there, but it become diversified. You can donate the money to, let's say, AAPI. If you like Dr. Kathula, Dr. Sancheti, Dr. Amit Chakrabarty, if you like them, you will donate anyway. Might as well donate NVIDIA stock. So there's a lot of options there. So sit down with your financial advisor.
So there's another question from Dr. Sachin. I don't know the last name, but I think you already answered this question, but let me read that anyway. So crypto indices have been down since last year, prior to which they were peaking. Is this a good time to invest in crypto?
Yeah, up to 1% of the portfolio crypto is fine.
1%, huh? Not much.
Yes, up to 1% we believe is okay.
Okay, that's fair. Thank you.
Next question is from, I think, Dr. Bharat Gupta from Fort Lauderdale. Market is going down. Is it a good time for Roth conversion?
Yeah, it's a good time to do partial Roth conversion in some of the stock which are down, but not the full amount because we have to pick and choose. Let's say, for example, it's a bad idea to do oil stock to do Roth conversion because they're up, right? But what you should do, let's say, if a tech stock is down, I'm just again going back to Microsoft because I see they are down 30% from the peak, it's a good time to do a Roth conversion if you think in the long run the stock will go higher. Yes, pick and choose partial is a good idea to do so.
And I think next
Another
question.
question.
Go ahead. Go
Yeah,
ahead.
go ahead. Go ahead. I mean, no, go ahead. Yeah.
No, sorry about that. What is your opinion about automated and AI running a portfolio compared to CFP or the
Yeah,
people like your company?
yeah. With time and time, they're getting better. AI is better than I am, I think, or other advisor. How can you compete with a robot? They don't get tired. They don't have emotion. CFA have like if they have a fight with their wife, God knows what the CFA will do with your portfolio. But but AI doesn't have those emotions, right? But I think it's good to have, in my opinion, some human touch. If the market is down, like you don't want to just click a button and AI just run the trades for you. But I do believe AI can do a decent, as good of a job of a return in terms of return I'm talking about than human financial advisor. But if you do need some hand holding, that's the only reason why you should have used a financial advisor, and then it justified the fee. The question is that are you getting that kind of service?
Okay, so I think we have the last question here, Dr. Bud Gupta. Which sector will go down first, you think?
I would not know which sector will go down first, but I do know that the tech sector is still a little bit overvalued, in our opinion. The multiples are very high. And we do believe that it may be a good idea to, when the market goes back up, and if you're concentrated, don't be concentrated. I've been keep talking about don't just buy Magnificent Seven. Try to buy, in my opinion, a diversified basket of stocks, ETFs, and index funds. As long as you do it, you're good to go.
So thank you. Any more questions anybody wants to put in the chat box? If not, it's 3:09 Eastern time. So it's been a little over an hour. So Vinod, do you have anything else
No, I
to
just see one
share?
question from anonymous attendee. When will be recording of this webinar will be available on API website?
Very soon, within 24 hours.
Thank you.
By tomorrow, it'll be there. Yeah.
Thank you. There's no further question. Thank you, Syed, and thank you, Dr. Kathula, for moderating this live webinar. And thank you all the attendees. And we'll see
So
you.
you want to bring Amit Chakrabarty? Maybe he wants to say he raised his
Sure.
hand for a while. If we can
Sure.
make him as a panelist, if it is possible.
Adel, Johan, is it possible? Do you see him at all, Johan, or no?
I see him in the participants raising hand. Yeah,
yeah.
yeah. I think he's in the panels right now. Panelists. Yeah.
Yes.
So Amit, you have to unmute to speak.
Oh, here he come.
Unmute, please.
You unmute yourself. You are muted. Yeah,
Can't hear Amit.
Sorry, yeah, we're unable to hear you.
Can you hear me?
Yes.
Can you hear me?
Yeah, we can hear you now. We can hear you now.
Okay.
Yeah, go ahead.
So basically, I have been listening to your seminar webinar. We are having a little trouble joining earlier, and I appreciate everybody in the panel. It was a great talk, Syed. I mean, you always have new information for us and timely information because and your webinars are not like a stale webinar that is just like from the can you actually adapt to the market things. I know that I've been following this along, and that is what makes you stand apart from a lot of the other people who do the webinars. The reason is that you look at what's happening in the market. For example, your title today was the geopolitical things happening, the war happening. So you adapt your talk to that, and that's what makes it very interesting. We really appreciate it. And sorry I couldn't join earlier because I'm traveling from I'm actually in Hartford in the lounge, Hartford, Connecticut, where we went for the governing body meeting. Dr. Vinod Sancheti was there, but he's lucky he could drive home. I have to take a flight home. And Satheesh, we missed you. So I really, really, really informative thing. I really think that we need to do more of this, and I really mean it. The fact that you adapt yourself to that, which makes it very, very interesting, and look forward to more such webinars. And thank you, Vinod. Thank you, Satheesh, for doing all the work, and I enjoyed it. Thank you, Syed.
Thank you very much,
Amit.
everyone.
Thanks for the opportunity. Yeah, thank you.
Yeah,
Thanks, everybody.
really
Thanks, Syed,
appreciate it.
Vinod,
Thank you.
everybody.
Thank you.
Thanks, Sancheti. Thank you, Chakrabarty. Bye-bye. Take care.